Ladies and gentlemen, welcome this morning. I heard, I wasn't there, but I heard for some of you it was a little bit of a late night. So for those that had a lot of fun, once again, my name is Matt Acosta. I'm part of the litigation and intellectual property group here at Jackson Walker, also a co-founder of the artificial intelligence, blockchain, and Bitcoin section of Jackson Walker. JPEG, RAM, random access memory, CPU, central processing unit, GIF, or GIF, depending on which side of the argument you're on. These are all technical terms, or they used to be 30 years ago. And now they have built their way, evolved into the vocabulary of the world. And that's just what technology does. It starts out as something small, and it grows and it grows and it grows until somehow we're all familiar with it. And Bitcoin and blockchain, only several years ago, started out as a whisper. And slowly, or quickly, depending on how old you are, it has become something that you see in the news virtually every day, something that some of you might even check on your smartphone to see what actually the price of any given token or coin is. So, Bitcoin, blockchain, what is it for those here that maybe all of you don't grasp it, because I certainly don't? Is it important, and is it here to stay? Those are the questions that our panel today will be speaking about, so let's introduce them. To the far right of me is my esteemed colleague, Mike Lasad. Mike is a Dallas corporate lawyer who focuses his practice on fund formation, venture capital, and securities law. Mike has extensive experience counseling fund sponsors with respect to formation and capital raising, regulatory issues, and the structure and negotiation of co-investments and portfolio transactions. Mike is also heavily involved in the blockchain and crypto asset space, one of the other co-founders, where he advises clients across a wide range of matters, including evaluating investment opportunities in crypto assets, regulatory compliance for initial coin offerings, and advising business entities with respect to corporate governance issues involving blockchain technology. To his left, we have Kelly Samuels. Kelly is a partner with Edwards, Kenny & Bray, headquartered in Vancouver, where she maintains a broad business law practice covering numerous sectors with particular focus in the areas of financial institutions and mining. Kelly has advised clients in the rapidly growing fintech sector, financial technology, including both startups and mature businesses focusing on providing Bitcoin wallet applications, lending platforms, and payment processing applications. Kelly has a particular interest in blockchain and its potential applications in both the legal and financial landscapes. To her left is Jay Gomez. Jay is a member of the financial services team at Trey & Trey, headquartered in Gibraltar. He has been recognized by Legal 500 as a rising star in the financial services sector and regularly advises prospective funds, investment managers, insurance companies, and banks on licensing requirements and regulatory, operational, passporting, and distribution matters. Jay is also very active in the fintech space and advises a fairly large number of crypto, blockchain businesses, and has advised on a large number of token sales. And to my right is our very special guest, all the way from Los Angeles, California, Pamela Day. Pam is the founder and CEO of Paladin Trust, a cryptocurrency custodian company that holds and hedges digital currencies for institutions, ICO companies, and funds. She built the trading desk at Paladin, and she has an extensive background in the securities industry. She's raised hundreds of millions of dollars in capital through both public and private capital raises and has built several successful entrepreneurial ventures in the Bitcoin and blockchain space. Pamela is also co-founder of Shios, a female-owned and operated block producer node management company with master nodes on EOS and GoChain networks. She has been honored with the Trailblazer Award by the Forum for Women Entrepreneurs and was featured on The Apprentice. Pamela holds an MBA from Harvard Business School and an economics degree from UPenn. Welcome all of our panelists. And first, we will start with Pam. Pam, could you tell us a little bit more about Paladin Trust and how you got interested in Bitcoin and blockchain?
Absolutely. So, actually, raise your hand if you know the difference between Bitcoin and blockchain. Like maybe a third. Okay. So, my background is traditional finance, right? I am a traditionally trained business person. And I got involved in the blockchain space really by accident. Had a bunch of friends who were entrepreneurs in the space, and I realized that there was lacking because the space was so much in its infancy. There were business controls, business processes, and just general business practices that needed to be applied in order for this infant space to be brought back into kind of the more institutional level investment grade space. So when I founded Paladin Trust, the premise was that these assets, Bitcoin, are no longer worth 5 cents. They're worth $6,500 each. So people were holding now hundreds of millions of dollars worth of digital assets. And there was really no trusted way or trusted institutional way to hold the assets and hedge them properly to other financial instruments. So if you think about what that means, if you're a company and you are holding these digital assets, say you're holding, I don't know, $100 million worth of Bitcoin. Let's just use that as an example. That fluctuates at least 5% per day. So imagine keeping a balance sheet where the underlying asset, which may be your largest asset, is fluctuating 5, 10, oftentimes 30% in a short period of time. It is extraordinarily difficult to manage that fund or that business. So being able to hedge those assets to the dollar or to another currency is extremely important for any business that's holding a digital asset that currently is fluctuating a lot in its value. So Paladin is what I consider the adult supervision in the room. Okay, we generally are working with companies that are technical companies that don't have a CFO, or if they do, it's a brand new CFO. They certainly don't have a treasurer. They may have raised assets with this underlying digital currency, or in essence, their capital stock is this underlying currency. So whether you are IBM and you're using the blockchain as a portion of what you do, or you're a company that's issued a token, is holding tokens, or has raised capital using these currencies, they cannot be held in regular banks. And in the same way that you don't sew $100 million into your mattress, it's highly recommended that you don't leave $100 million on a USB drive in Justin's office down the hallway. And that's how we found that most companies were actually running their financials. So that's a little bit about why I founded Paladin.
Okay, let's back up just a bit. For those 2/3 of the room that don't know what the blockchain is, could you give us a little background on blockchain?
Okay. So blockchain is the term that we use for the underlying technology for these tokens Bitcoin being one of them. It just happens to be the most well-known. The underlying technology, theory, and practice, the protocol of how this works. And what blockchain does, in its essence, is it solves the two generals problem, or sometimes called the Byzantine generals problem. What that problem is, it's a theoretical problem that was not solvable before in networking. If you have one computer here and one computer here, or a general and a general, and in between the two of them is an army that would either capture your messengers, or perhaps there are spies that would change your messengers. How does this general talk to this general and know that that message was not intercepted, changed, or destroyed, okay? And that underlying networking problem has plagued the internet since it was founded. I don't know, it's now almost been 50 years, frankly. TCP/IP, the protocol that we send information on the internet, is not secure. We all know that, right? I think you all know that. It's not secure. And so the internet up till now has been a great way to send unimportant information, okay? News, tweets, right? Photos. That's what the internet right now has been really great for. It's been not great for sending very, very sensitive information or money, right? Or money. Or anything else that is mission critical, because it requires so much encryption to actually get information back and forth and ensure it hasn't been harmed. So what the two generals problem says is there's really no solvable way to get a message to this general and to confirm the receipt of that message and to confirm that it hasn't been in any way altered. What blockchain technology did was it solved that problem. And what it does is it takes an underlying piece of information, okay? It requires a computer or a series of computers in a distributed network, so a distributed ledger. The distribution has to be broad enough so that there is not enough concentration in one person or one holder of the network to actually affect it, okay? So broad spectrum of users, so you have something called nodes. So picture now you've got enough nodes running a network around the globe, and each of those networks has to check in with a piece of data, and it has to solve a problem. And that problem is a cryptographic problem. It takes a lot of computing power. And once it solves it, it then registers that on a block. And that solution, that hash, becomes the next block. So the next computer or series of computers that is using computing power to solve that problem is looking at the prior block, noting the time, date, the stamp, and all of that, and solving the next problem. What this means is by the time a message gets to any node or any other user on that network, there is no way to hack all of the blocks of information on which that has been built. Each block is built on the prior block. That's why it's called a blockchain, okay? And if one node is infiltrated and hacked, it's like a starfish. You can chop that one off. It is not going to infiltrate the rest. It can't, because there isn't one computer or server or node. There isn't one master server somewhere. There isn't one Amazon server farm in Seattle. They are distributed everywhere in the globe on lots of different types of servers, lots of different types of people. So this level of security, that's why we call it crypto, it's encrypted, and it cannot be altered. By the time a piece of information comes to you or to me, there is no way for anyone on the globe to go back and alter what that record says. So if you think about what that allows us to do, right? Think about the amount of effort we put into making a dollar not counterfeitable. Now, they still counterfeit it, right? But it's a lot of effort to make that dollar so intricate that it's incredibly difficult to counterfeit it. If you look at Bitcoin, it is impossible to counterfeit it, okay? Because every single block that makes every single Bitcoin has already been validated on the node, and you can't undo it and you can't redo it. Okay? Is everybody following me so far? So what this allows us is a protocol different from TCP/IP, a protocol to send things that we know the recipient is going to know are true, correct, and complete. So that is the true, correct, and complete information, and no one could have intercepted and changed that. So the type of information we're now able to send on the Internet, so this is now Internet 2.0, it transcends just information and news and tweets. You can now send, hold, or move around information that's highly sensitive and needed to be validated. Money, okay, which is why cryptocurrencies have become a topic of conversation. These are now not counterfeitable and easily movable without a central bank, without a clearinghouse. So that's extremely unique. You can also move information. And the first protocol on this blockchain, which really kind of blew everybody's mind, were really used for currencies and things like this, right? Bitcoin was very new. The next version of that is taking that block and adding another piece of data onto it, which we call a smart contract. So you can take that block, which we've now validated, right? And as we move it around the globe, we know it's true, correct, and thorough and complete. And now you can slap a contract on it. And that contract can tell that piece of information, that block, what to do and where to go. And now think of the implications of that. Think of what a bond will look like in the future, or a stock certificate, or the title to your house. There is no need for title to be a piece of paper anymore and for you to have title insurance if the blockchain has validated that. Think about what that does for healthcare records. Think about what that does for LTL trucking records. Think about what that does for government records and for any other type of contract. Now, we are doing this already with relatively small contracts. The contract can be, I'm going to send you money if you perform this action. If you don't perform that action, the money comes back to me. Think about the implications for escrow, for insurance. Think about all of the middlemen and the people it takes to make the world go round. And now think about the fact that you can layer that message, that contract, onto a piece of data and send it to someone else. And that is what's so mind-blowing, I think, about this technology, is because it's the Internet now with encryption and now with the ability to send those contracts so that they could never be altered.
So Bitcoin, which you've spoken about, is by far the most popular, I'll say, application of the blockchain. Now, some in this room may have heard of other applications, such as Ethereum or Ether, and there's Dogecoin. It's funny. It started as a joke, and now it has independent value, which is one of the strange things that happens on the blockchain. And so you mentioned earlier a token. Yeah. What is a token, and how is it different than Ether or blockchain or Bitcoin?
Okay. So now, try to get your head around. Each one of these networks is different, right? This is this burgeoning new technology. So each network that I just described that's creating these blocks may be slightly different. One may be optimized for privacy. One may be optimized for sending larger contracts. The optimization and the type of technology, even the code on which they are written, and the way each of the nodes computes is different. Because we are in the place in this industry where it's still the Betamax versus the VHS. We don't know which one is going to win, right? So there are lots of different technologists who are out creating different types of networks. Ethereum is a different network than the Bitcoin network, okay? There's Betamax and VHS. Now picture that there are about 350 of those Betamaxes and VHSs who are all vying for the position, the pole position of being the best network on which to transmit. That means that each of those networks is run by all those nodes I was describing, right? Well, who owns those nodes? If you think about it, when we've got a telephone system here in the United States, somebody went around and actually put up a bunch of telephone poles. One company did that, and they owned those poles, and they owned those phones, they owned those lines. Now, nobody owns those lines, and master node companies, like one that I manage, put up each of these poles. And you better hope to God that those master nodes who do this just for fun keep running, right? All of these are volunteer positions around the globe. Volunteer positions. Now, what you get for running a master node is you basically get to print yourself a little toll booth, and you take a piece of that particular, we call them tokens, okay? So for each system that's running these blocks, each piece of information or incentive piece that it may throw off, we call a token or a coin. And all that is another piece of information that we can now trade, okay? So we ascribe a picture to it, we ascribe a name to it, and we ascribe a value to it. And the node operators and the users of each of these networks has every incentive for that token to be worth something. So we think a lot in this space about economics, what we call tokenomics. The usability of those tokens, how do people use them, how do they flow through the network, and why does anybody care? And to think about what a token is, I liken it to airline points. Does having 100,000 airline points on American change your behavior for who you're going to fly on? It does. It incentivizes you to fly on that. And you can use those points for other things. Now, do you sell them to your friends? No, but you can sell them. There are markets to sell those points, and you can use them for upgrades and drinks and hotels, and those are currency. American Airlines points are currency. Thankfully, the IRS doesn't really come down on us for that, but they really are currency, and they are used as currency. You don't hand them out at Halloween to kids because they're very hard to actually transfer to someone. But if they were easier, if I could just send you 10,000 points in exchange for Starbucks coffee and do it with my phone, I very well might do that. And so American Airlines created a network, okay? And they created a token. And so did United, and so did Delta. So it's the same thing, except instead of flights around the world, we're moving information. And it's actually relatively easy to create a token. It's actually incredibly easy to create a token. I tokenized my dog. It took me 5 minutes. There's Poco Coin available on the Waves network. It takes 5 seconds. What's hard is getting anyone to care or getting an economic reason for that token, okay? So Bitcoin, as you mentioned, Bitcoin around the globe has about the same recognition as Coca-Cola. It is amazing. Why does everybody care about Bitcoin? Because it was the first. And now it's become the gold standard. We actually register coins as value versus Bitcoin. It is the dollar in our world, okay? And I feel very strongly that it will continue to be the gold standard for actual money, for currency in this space. Other tokens may have very little value. It depends. If you have the Starbucks token and you eat Starbucks every day, you might really ascribe a very high value to that token. Now, if you are a company, if you are a network, it behooves you to have these tokens, right? For loyalty, for payments. Think about every time you go into Bloomingdale's and they try to get you to use a Bloomingdale's card for a 15% discount. Why? Because they don't want you to use Visa because it costs them money. Well, if they had a Bloomingdale's card that used tokens, instead of actually having to clear the finances through their own financial clearinghouse and banks, it'd be even cheaper. They'd give you a 20% discount, because they don't have to clear the funds through the banks. It clears itself. Make sense? So you'll see what we believe is going to happen, what I believe is going to happen, is a proliferation of more and more tokens. And this it sometimes becomes mind-blowing. But when I was a kid, we had 3 television networks, right? 3. Then there was a 4th. I thought that was crazy. If I turn on the television now, I don't even know how many channels. There's like 1,000, right? And that is only growing. And anyone in the entertainment business will tell you that that becomes more and more closer to infinity. And the usage of YouTube makes it even closer to infinity, so that your consumption becomes more and more specific. Tokens will be, in essence, the same thing, and we see that now. There are hundreds and hundreds of them. There will be thousands and thousands in the coming years. And those tokens will be used for multiple things. Now, the interoperability of one token type to another will also be an interesting ripple in this, right? Having the ability to transfer one token to another, are they all on the same network? Are we on Betamax or VHS? Those are the arguments that we don't have answers to right now, but that's the struggle going on amongst these networks.
Thank you. Much to their disappointment, I'm going to rope in the other panel members. So let's talk a little bit about why your clients, your businesses would create a token. So there's something out there that has been talked about, and maybe you're familiar or not, but it's called an ICO, an initial coin offering, not stock offering, coin offering. So Mike, tell us a little bit about why, or what is an ICO?
The real innovation with the ICO is, taking that token. We're developing a new application that's going to be powered by a token. The real innovation was recognizing we could sell that token to the public before the application is fully developed. In effect, creating an alternative to traditional venture financing. And this is when the lawyers start to take what is a very fun and exciting world and try to suck all the fun out of it by imposing our legal concerns on it. But, I mean, the idea is that you buy the token now, presumably at a cheaper price than you would have to pay to get access to that token once the application is fully operational. And there's also the implication that maybe you'll be able to sell that token into the market for some kind of profit if demand and supply are properly managed. This was a very powerful idea and very successful. We had in 2017, somewhere around $6 billion with a B dollars worth of ICOs. 2018, are we past 15 billion already? What's the number now?
I believe so.
And it's working. You have companies that would have had trouble raising $1 or $2 million in traditional venture financing, raising $10, $20, $50 million in ICOs because it was very popular. It was a smooth process as compared with some other capital raising techniques. And it's fantastic for the companies because it is not dilutive at all. If you're getting venture financing, you're giving up a chunk of your company. You're giving up a percentage of your profits, a percentage of voting control, and in some cases, extra voting rights to large venture investors. With the token sale, there's none of that. It is financing to the company without giving up any of that control. But the last little bit, when an investor is evaluating whether they'd like to participate in one of these ICOs, that notion that perhaps they might be able to profit by reselling it later is where it starts to become very much like a security. And so these ICOs were operating in a bit of a gray area for a while, waiting for regulators to weigh in. And last summer and fall, at least in the US, we finally got the SEC starting to lay out their theory of the case as to why cryptocurrencies, particularly those offered to the public for money by a specific company, should be treated as securities. And the responses were varied. Some people chose to just ignore that. And to their credit, even to this day, the SEC and the various state regulation, securities regulators in the U.S. have really spent their time in terms of enforcement going after scams and frauds, actual bad actors. And so some people that have just ignored those restrictions have still been able to continue on, kind of waiting for more guidance. Some people took the approach of simply not offering these tokens in the U.S. or other jurisdictions that took the stance that these were securities. Sort of the third stage that we're spending more time on now, and that groups like Paladin help enable, is accepting the fact that these are securities and offering them in compliance with securities laws using the same exemptions that have been available to us for private offerings of securities for decades. So that creates tons of stuff that's at least interesting for securities lawyers, which is a really low bar for what's interesting. But that's what we're spending a lot of time on in the U.S. Jay is in Gibraltar, and they are doing lots of really interesting things to become a hub for this. Can you tell us about them, Jay?
Sure. So I think I need to rewind the clock a little bit, perhaps, and put into context where Gibraltar's journey begins. And to do that, I need to almost park to one side of the blockchain, crypto, DLT world, and start off with where the tech know-how really comes from. So in the early 90s, Gibraltar found itself in a position where a number of fairly high-profile individuals started setting up e-gaming companies there, so online casinos. At the time, there was no regulatory framework for that. So these companies were setting up on our turf and undertaking an activity which was questionable in terms of its morality and the risks that came with it. In particular, these businesses were handling large amounts of money, not subject to any AML, customer due diligence measures. So from a jurisdictional point of view, that posed a significant amount of risk. What the bold move that the government took back then was to regulate those businesses. And the way that was done initially was by giving them a license under contract, where the gaming company had to comply with certain requirements if they wanted to operate in Gibraltar. And one of those requirements was doing KYC, customer due diligence on the punter, on the gambler, before they were allowed to place a bet. Interestingly, many of the issues that are faced nowadays by companies operating in this space are very, very similar to what, in the blockchain space, are very similar to what was experienced by the guys in the e-gaming sector. It was issues to do with credibility, licensing, banking was almost impossible. And licensing started to bring those entities into a more acceptable space where essentially they were regulated to the same level as any other financial institution was. So it allowed them to then interact with the traditional financial services sector and get banking services, asset management, insurance, etc. We then started to notice that there was a huge growth in the tech know-how that was basing itself there. Guys extremely knowledgeable on the tech side. We started to see a lot of guys walking around in board shorts, flip-flops, all the sort of what we would call the tech geeks. Those guys then started spinning off into the payment sector. They realized that there were huge issues with the online gaming space, the way that they cleared payments. They started setting up payment solutions to help that. Then, about 5 years ago, we had our first client approach us on a Bitcoin-related business, which, as Pam was saying, is kind of the first. It was the first crypto. That then started to sound very similar to what had happened to us in the 90s, where we actually had again guys operating on our turf in an environment which wasn't regulated, and we felt that there was, as a jurisdiction, that it posed risks to our reputation as a financial services jurisdiction. That led to bigger businesses being set up there. I mean, the likes of Token Market and some of Pam's competitors as well, which we shall not name. So the decision was taken that there was a need for licensing. We had to put in a regulatory framework in place to protect essentially these guys in the way that they were operating from Gibraltar. And Pam spoke about the fact that it's very difficult to counterfeit in this space. But of course, there are other risks associated with operating in this space, and there's a risk of consumer protection, which is obviously extremely very high on any regulator's risk profiling, and AML risks. So the decision that was taken was to put what we call our DLT regime in place. So that stands for distributed ledger technology, which is the tech that Pam was describing a short while ago. And that meant that businesses could then, operating in this space, that were either storing or transmitting value belonging to others on using DLT to apply for a license. It meant that they were now regulated to the same level as any other financial institution was. It gave them the credibility that they needed. It allowed them to access the traditional financial services sector for banking, insurance, anything that they might need, because now they were regulated to the same level. They were doing the same customer due diligence measures as the banks were doing, for example, when they opened a bank account for one of their clients. That then led to the token sale craze. So Gibraltar was perceived to be crypto-friendly. As I said, we had the tech know-how there, and we saw a huge amount of token sales flocking in, which in itself brings another set of risks with it. So I sit on the Finance Center Council, which is a board of practitioners and industry specialists who advise the government in terms of policy generally on financial services. And the view that we've taken is that essentially there are a set of risks there which need to be addressed, can't be left as they are. And we just can't dig our head in the sand and think that this is somehow going to go away and that these businesses are going to disappear. I think I completely agree with what Pam was saying. It's here to stay in some way or another. We don't know what it's going to look like, but it's definitely here to stay. So it's how do we address that? How do we regulate that? And how do we make sure ultimately that we can help them, that we innovate and we allow them to grow their businesses?
Jay brings up an extremely important point here that as lawyers, we need to really parse out. What is domicile? Where is something located? Where when I just told you it's in bits and pieces around the globe. Where is a company located? When you no longer have your servers or your employees in any one place. Where is the asset located, right? How is it taxed? What jurisdiction? So these become really tough questions to answer. The more things become hyper-distributed around the globe and not technically owned by anyone, okay? So this is why Gibraltar, Jersey, the Isle of Man, the Cayman Islands, the state of Wyoming have been so successful in bringing huge amounts of business, interest, and intellect to these areas. Because now, when one creates a company, especially in a distributed environment, can domicile it anywhere. And you may never even visit that place, okay? You may never actually show up. And you may have no employees there and no assets. So what does it mean if you own $100 million of Bitcoin? And as I just described, all that means is it's pointing to code around the globe. Where is it located? And what the consensus is right now is it depends on where the keys, okay, the keys to a piece of software, which we call a wallet, where they are actually held. Now, they may be held in your head, but where do you claim that they're held? And this also gets to the idea of why use a custodian. So Paladin Trust is domiciled in the Cayman Islands and the state of Wyoming for very specific reasons. It's not because I live in either of those places. Just like there are lots of clients who will domicile in Gibraltar for a host of specific reasons. And those assets, meaning the cryptographic keys, need to be held in those actual domiciles in a custodian, because you guys don't want to live in Wyoming, and neither do I. So when you think about this, okay, the location of your domicile and your domicile attorney, the location of your custodian is going to drive the taxation, it's going to drive the legal domicile, it's going to drive so many decisions, even though you may be working with your client right here in Dallas.
Now, I want to tell a quick story, or maybe it's a trope, as we say. So the value of this technology, I think, in the business world has been demonstrated in a joke that I've heard. I've heard the saying that if Kellogg came out with a blockchain flake, they could sell that cereal for $10 a box or $20 a box rather than $5 a box, simply by putting the name blockchain on it right now. And I've heard the joke, but last time I went to a tech conference, there were people pitching investors, and it was a contest where the best idea, the best pitch won, and they won an investment or some loan. And one person came up and pitched, and the name of their company was, let's say, Blockchain Medical. They get done with their pitch, and one of the investors stands up and says, okay, but what does your idea have to do with blockchain? She couldn't answer the question. Once again, the investor says, okay, well, that's not an answer. What does it have to do with blockchain? She can't answer the question. She had literally put blockchain in the name of her company, even though it had nothing to do with blockchain, simply to raise money, simply to increase the value of her company. And that's a danger, right? And so, Mike, talk a little bit more about how that danger has been recognized and how at least the United States government has tried to deal with it.
Yeah, and that's some stuff you saw early on with publicly traded companies in the U.S. just adding blockchain to their name. They're making juice, and suddenly they add blockchain to the name, and you see a spike in their price. And that's the kind of stuff that the SEC cracked down on immediately. And so you are seeing the space grow up a lot. The custody problem, where these assets are held, is an interesting part of that. And then a really important part of it is exchanges. So, how do we move these assets around? And so Kelly's got some experience and can do some explaining on how some of that is working in the space.
Sure. So crypto exchanges are essentially businesses that are located online that allow customers to exchange their it's basically for a lot of people, it's the entry point into the market. So it allows you to take your regular dollars, your traditional currency, and exchange it using a wallet or using the wallet that they provide for you, sort of in a seamless interface for Bitcoin or Ether or any number of digital currencies, whatever they might have available on that particular exchange. The other thing you can sometimes do, depending on the exchange, is exchange a virtual currency for another virtual currency. So the issue with that is that has arisen, I think, in at least our jurisdiction, and I think others as well, is how is that regulated? I think initially these things popped up, and they were just, again, operating sort of like the ICO world in a bit of a gray area, and people were putting money into them, buying Bitcoin, holding Bitcoin in a wallet on that exchange, which is online, and then having maybe that company just dries up and goes away, and along with it your Bitcoin. Or there's been these very high-profile hacks where people have just lost Bitcoin and somebody got in there and took it. So there hasn't been a real regulatory environment around that. I think that we're starting to see now, at least in some jurisdictions, regulation about this. So some jurisdictions have been very friendly and active in this space, and they accept businesses setting up as a cryptocurrency exchange if they register with a particular financial authority in that jurisdiction. I know Japan, for example, has that regime. I believe Korea as well. Canada, we don't have that yet. We don't. It's, again, regulators have been, I think, waiting to see who does what first. In Canada, securities are provincially regulated, so I think the jurisdictions have been hesitant to jump in and take a position before the other ones have. Like, I don't think British Columbia, where I'm from, wanted to jump in and take a position before, say, the Ontario Securities Commission did. So we've kind of had a bit of a cat and mouse game. But in Canada, at least, and I think probably in the U.S., a lot of these businesses have had to comply with certain anti-money laundering and know your client legislation just so that they can have their clients access their bank account so that you can transfer money in. You might do it, some allow it by credit card, although I've heard some credit card companies or some exchanges are cracking down on that. They don't want people buying their Bitcoin on credit, protecting people from themselves, I guess. And also sometimes you can wire money in. But so just by wanting to comply generally with AML laws, cryptocurrency exchanges have done that just to facilitate their business. But as of yet in Canada, there's no requirement to do that. We've seen some draft regulations come down from FinTrack, our anti-money laundering authority in Canada, that brings in virtual currency into our anti-money laundering compliance regime. And cryptocurrency exchanges will need to be registered with FinTrack as money services businesses, and with that will come obligations. You'll have to have a compliance officer. You'll have to have a compliance regime. You'll have to report suspicious transactions. You'll have to report transactions above a certain amount of money. So it will bring that in, and there will be regulation, but as of right now, it's technically not there. The other issue with the sort of crypto to crypto exchange is that if you're buying tokens, there is an issue with securities law in Canada anyway. If you're buying something on the secondary market, are you even that could have been could have been issued under exemption that puts a restriction on the time in which you're allowed to trade it, and are these exchanges complying with that? Probably not. So there's a lot of issues around the cryptocurrency exchange, but I think as time goes on, we're probably going to see more clarity, because I think regulators are onto it now, and they're going to be, at least in many jurisdictions that's already happening, but we're a little bit behind in Canada on that. I'm not sure in the U.S. if it's the same situation, but
we all feel behind compared to Gibraltar.
Yeah, that's very true.
And I'd just like to add a few things to that, if I may. So as Pam was mentioning earlier, the protocol, the technology is almost impossible to regulate in any way. I mean, you have it's distributed, right? It's all over the world. You've got nodes sitting everywhere, potentially. And it's very, very difficult to regulate that. But what you can regulate is the access points to that protocol. And that's where the risk lies for the consumer. When they transfer the money to that exchange to buy a token, a cryptocurrency, are they actually going to get it? And if that exchange fails, is the exchange going to have the capital segregated to be able to pay out that purchaser? And that's where the key is. And then to add on to that, you've got the whole AML risk, right? The fact that you've got anonymity in most of these cases. So you need to make sure that the access points into that protocol is controlled in some way. Otherwise, it's like allowing cash transactions to happen where we have complete anonymity in cash. So that is really, really key. And as I mentioned earlier, a lot of the potential issues that are faced by these companies are very, very similar to what was faced by the online gaming sector. The fact that they might fail, they might not be able to pay out if somebody wins, and the risks are very, very, very similar.
And the challenge as lawyers in dealing with this stuff comes down to trying to define a technology that's rapidly evolving. Delaware passed laws in 2016, very modest changes to their corporate laws to make it clear that you could keep a corporate stock ledger and other corporate records on the blockchain, that it was okay for those records to live in a distributed fashion. And we've drafted amendments to the Texas Business Organization Code. All sorts of states are following suit, some being more progressive than others. But the challenge you run into is trying to describe what this is, because if you spend any time in this space, you stop feeling like a cool kid really quickly because you're using words that were the right words 3 weeks ago, but because you haven't been paying attention to the right Reddit page or whatever it is, those aren't the words that we use anymore. And when you're trying to draft legislation that's supposed to stand the test of time, it's really difficult. And it's a twin challenge, too, because we're drafting an amendment to a complicated seeming statute. We need to be able to signal to the legislature, hey guys, this makes blockchain work. And lets corporations whose boards of directors decide that this is a technology they want, use it. So we need blockchain somewhere so that they know what we're talking about. But I'm terrified that using that as the descriptive term is really going to get me in trouble, because they define it, when you define it as saying it is immutable, just that alone. I mean, what if it's not completely? Does that count? And so as the technology moves, trying to capture that in legislation in a way that doesn't hinder innovation is important, but it is hard.
So as you bring up laws, it is important to note that the states, and I know there's a global group, but if we focus on the United States for 1 second, the laws state by state are extremely difficult, or extremely different rather. And the one state that has been by far the most progressive is the state of Wyoming. The state of Wyoming passed 5 highly progressive blockchain-related laws last year in its legislature. One of them removing money services business requirements for locating there, the anonymity trust laws, things of this nature, utility tokens, not requiring them to be securities. So literally, in the state of Wyoming right now, you can domicile a company, an LLC, create a token, sell it solely to other people who have created investment vehicles or investment companies in the state of Wyoming, as many as you want, and it is not considered a security. You don't have to register it anywhere. And their privacy laws are so strong that you don't even have to register that trust, if it's a trust, or the only person you have to put on your LLC filing is your registrant. So the privacy laws are incredibly strong there, the corporate laws are incredibly flexible there, and the blockchain laws are incredibly progressive there. And why did they do that? They are trying very, very hard to bring these types of businesses to the state of Wyoming. There's another legislation piece that's up for vote in January that I helped work on, and that is a banking custody law in Wyoming, to create a new type of bank. Because if you try to read bank and trust laws, this is not contemplated in bank and trust laws in the United States, and probably anywhere. Bank and trust laws were written, I don't know, 100 years ago, maybe 200, and they contemplated holding things in vaults, 9-gauge vaults or whatever they're called, right? Gold, silver, dollars, and things of this nature. When's the last time you walked into a bank and there was a hunk of gold bars there? It doesn't happen anymore. Those laws are no longer applicable. And so these banking laws have to be rewritten. What is a bank anymore? What is a trust if what you're holding are cryptographic keys? What does that look like, and what are the requirements for it? And instead of saying, well, you've got to have Brinks trucks, now, well, you really have to have a technical audit, right? So the state legislation, I think, is a lot of people are going to look to Wyoming. By the way, you walk into Wyoming, they don't strike you as the most technically savvy cats, right? I mean, they're wearing cowboy hats, and they generally have, these are ranchers.
Hey, cowboy hats.
I love me a good cowboy hat, but you see what I'm saying? So I think that the states, to your point, like Texas, are going to be looking to these very progressive states to see what works and doesn't work. And where you domicile your next entity is going to change dramatically, I argue.
Just for the record, nowhere in this panel did I admit that Texas would look to any other state for anything. It was Texas. Thank you.
Okay, so switching gears a little bit, another application of the blockchain that we heard about earlier is contracts rather than currency. And so, Kelly, tell us a little bit more about the contract application of the blockchain.
Sure. So a term that is thrown about a lot now with the advent of other blockchains in addition to the Bitcoin blockchain, like the Ethereum blockchain, is a smart contract. And I know that people have said to me as a lawyer, like, oh, your days are numbered because I draft contracts for a living, and you know, these electronic contracts on the blockchain they're going to put you right out of business. And so I looked into this a little bit a while ago just out of interest and because I was a little concerned. And the simplistic example, I guess, of what a smart contract is really just an if-then, you know, if this, then that, right? So if you do something, then this is going to happen. It's deterministic, meaning it's if you put in a specific input, only one output can follow. I think that for smart contracts, I'm just going to check my notes here. So the simplistic example that I've heard of is a vending machine. So if you put in your money, it triggers the option to enter your code of what you want. So you press, you know, C12, and that triggers the release of your chocolate bar. And that really is sort of a very non-computerized example of a smart contract. But there's also other applications that with the advent of blockchain technology, such as sale of music. So thinking of blockchain as being a decentralized application, so there's no middleman, there's no central authority. A musician could sell on a peer-to-peer basis a song. So you go to that musician's website, you pay your $1, you download the song. It's all done automatically. So if you pay your $1, you get the song, and then that money is divided up, you know, partly to the musician and then maybe partly amongst her other collaborators. I believe that has been actually done. So how is that going to affect us as lawyers? I think some of the advantages backing up a little bit, I guess, can a contract in its entirety be built in code? I would argue no, because a traditional commercial contract, at least in my jurisdiction, is going to include lots of other things besides just the execution portion of it. So we're going to have maybe things that need to be done on a best efforts basis or a reasonable efforts basis. We're also going to have a lot of reps and warranties, and that, at least at this point, I don't believe is possible to codify in a computer code. So probably you would have a hybrid situation where you would have a written contract in regular legal prose that's going to outline the reps and warranties and what's the agreement between the parties, but then maybe the execution portion of it. If this transfer of property is registered in the land registry, then these funds will be transferred to the seller of the property. So maybe part of the contract is in legal prose, but the execution can actually happen on the blockchain. And I think the advantages of the smart contract side of it is that there could be decreased monitoring costs. Because this is sort of all automatic and happens in a predetermined code, you know it's going to happen the way it's supposed to happen, provided the code is right. That's kind of another disadvantage potentially, right? Like these are things that are still a little bit in their infancy, and then if it does go wrong, who's at fault? Is it the person who drafted the code? Is it the person who coordinated the programming? So there's some issues there. And then another disadvantage, I think, is privacy. At least maybe there's going to be blockchains that will have more privacy down the road, and there are ways to make things pseudonymous. But the commercial terms of an agreement as between parties, if it's solely in a written form or not on a public ledger, would be private. Like you could keep it confidential. Once you put it on a public blockchain and it's distributed all over the world, there's going to be some degree of knowledge about your commercial transaction. So that could be traced or looked at. So those are some of the issues I see with smart contracts.
So let me add to that. If your head is still spinning on the smart contract, you know, how are we going to do this? I don't see in the next at least, maybe even ever, removing lawyers from the equation. That's not going to happen. So everybody calm down. Your jobs are good. But what I do see, so picture when we say smart contract, a bond. Now that bond is going to pay out, let's say you had a Bitcoin bond, right? And you were going to sell somebody this Bitcoin bond and it was going to pay a dividend every month, or it's going to pay its interest every month. You are no longer, if that is built in a smart contract, going to need an administrative human being to oversee that, okay? The bond is going to pay. That's what that instrument is meant to do. If that instrument fails, it's because the company fails or the bond fails. So if you're not paying in dollars, if you're paying in a token, right, a bond offering would now be tokenized, is the phrase that we use. So bond offerings are, in my mind, the most immediate, and we're already doing these. Daimler actually did a tokenized bond offering about a year ago. We're doing this. We're securitizing real estate this way now and testing these out on certain types of real estate assets, not just for breaking up the ownership, but the actual payment of those dividends. So when you break it into that type of a contract, that's really the most immediate use of a smart contract, in my opinion, is that systematic payment, systematic movement of portions of that token.
Can we just touch on the coding point? Because I think it's quite an important one as well. I mean, we talk about how important that coding is, and the reality is that there have already been issues with coding, particularly on the token sales side. I mean, there have been token sales that have raised a significant amount of money, and when it comes to releasing the ether, that gets locked up because the code was screwed over, and it ends up in the wallet that they don't have access to. And there is already litigation on that. You know, who is responsible for that error? Is it the coder? Or was it the auditor that was meant to be checking that coding was correct? And when I talk of auditor, I don't mean your KPMG or PwC. I mean smart contract auditors, guys that are meant to be checking the coding, and that is their business. So that is a key risk and a key factor as well when considering smart contracts, making sure that coding has been tested beforehand, so that when it does go live, that you don't end up with that scenario where suddenly you've lost everything that you've potentially raised.
And it really goes into how we're training and developing lawyers. You know, when I give kind of an intro presentation on this, I first throw up one screen that shows a page of Solidity code, the programming language on the Ethereum blockchain that looks a lot like JavaScript, and it's a page full of stuff that means almost nothing to most of the people in the room. And then I throw up a page from one of our private equity fund partnership agreements that has all the tax provisions in it, that again means almost nothing to almost everybody in the room. And when you're talking about auditing this stuff, where these very complicated concepts that live in agreements that we've all been working on for years are now living in code, it's a marriage of these two worlds. Yeah, you can screw up on the coding side, but there are legal concepts being built into this stuff that we think about all the time that the tech folks can screw up. And when the impetus for the SEC in the U.S. finally opining on this stuff was something called the DAO, the Distributed Autonomous Organization, which is essentially a venture fund that was set up on the blockchain. And instead of a partnership agreement written by really good-looking fund formation lawyers in Dallas, it was a smart contract that was just living on the Ethereum blockchain that was written by really talented coders that were probably also very good-looking. But there was a bust in it, the same way that we all hear about mistakes that are potentially made in legal contracts, not anybody in this room. And it led to, this was a fund that raised $150 million, right? And about $50 million of that was able to be siphoned off into an account that led to all sorts of exciting political things that were very exciting in the entire crypto world, and led to a lot of changes that are fodder for a completely different panel. But the simple fact of $50 million disappearing because there wasn't somebody that was trained in both the legal concepts and the code at the same time is a big deal. And so the notion of hybrid programmer lawyers or a rise of consultants that are being able to do this stuff, and I'm sure, you guys work with the auditing consultants all the time. It's a very early space, and so, it's kind of a new career that's available there for people.
Yeah, I mean, even assessing who's qualified to be an auditor can be extremely tough.
Yeah.
I mean, how do you validate that somebody actually has the experience to audit the smart contract that they're telling you they can audit? It's very, very difficult. So what we find is that the majority of their times, our clients actually use more than one, in the hope that hopefully one of them might actually be able to do what they said they were going to do.
And remember that most of the blockchain developers are under 30 years old. So if they've been in this for 5 years, they are the oldest ones, you know, in the space. It's that new. So you're generally relying on these guys, like you said, in board shorts and flip-flops, who you're hoping to God they know what they're doing. So the concept of an auditor will change. You're right. Even the concept of an attorney over time, you will have to be well versed in this. You will have to understand, even if you're thinking, no way, man, I work for Coca-Cola. We don't do this stuff. You will. You will have to identify smart contracts. You will have to identify things like provenance, right? If you're dealing with art, if you're dealing with anything of authenticity, if you're dealing with private wealth management, how do people access these types of assets? How do you know that they're legitimate? How do you know that the group selling them to you is legitimate? How do you hold them later? There's 1,000 reasons why you're going to care. Just as Michael said, you're going to be writing this into your contracts. What would happen to this asset if it became somehow identified on the blockchain? Or how do you do business with a digitally distributed company like a DAO? I mean, there was a story of the Kanye West coin, right? Coinye. Had nothing to do with Kanye West, and so they wound up suing somebody, but the only person they could sue was like a Gmail account. So how will your companies, how will your clients deal with that in a distributed environment? And how will you identify that for your contracts for your clients?
And for the European lawyers in the room, in particular, I think I'd just flag, make sure you don't dig your heads in the sand, which I think is what Pam was saying. I mean, before coming over to Dallas, I was in London, and I met up with one of the Gibraltar diplomats from the European Union, and he updated me in terms of what was happening in the European Parliament. And there is a big, big drive in the European Parliament right now to embrace blockchain technology and to start to analyze how to regulate it. And it's being driven in particular by the MEP for Greece. And there is no doubt that the European process will take time, but within the next 5 to 6 years, I have no doubt that this will be regulated on the European continent in some shape or form. So stay ahead of the game.
So our friends upstairs at KPMG, hopefully when you buy their services, you assume that they're licensed, and so they have some sort of expertise. In Gibraltar, are they trying to put up a licensing scheme for auditors, or is it just the guy who says, my flip-flops in my brain are great, and I can do this?
So we haven't quite got there yet on the auditor's side. It is a real difficult one. I mean, we were talking a moment ago about how legislating in respect of this tech is extremely difficult, because tomorrow it could be out of date. And I mean, we've seen all sorts of examples on that. We saw the BIT license in New York, I think, is a really good example of how legislation can be overly complicated and very quickly out of date. I mean, the way we've dealt with that up until now is to have principles-based legislation, which can be interpreted as the tech develops. That isn't great for lawyers, because it means we have to do a certain amount of interpretation, and there can be a bit of lack of legal certainty at times. So on the auditor's side, no, we haven't legislated yet in that respect. I think we will eventually. The question is, how do you do that? And we haven't yet started the process of looking at that. There were more urgent legislation that we had to take care of first.
That's your blockchain auditors. So I think we're about running out of time, but I did want to open for the opportunity for a couple of questions. So just, I think, Bob?
Thank you. I was just wondering if, because now the panelists, you talked a lot about regulating the entire thing, and it's just recently that I got involved with this Bitcoin currency and also the blockchain technology. And I said to myself, after having understand the basics of it, that I completely revised my earlier assumption that this was something that would go away, because the first being that the currency is very secure. The second thing is that it's not regulated, not under any government or banking control, and you can trade it anonymously. And I said to myself, this is going to stay, because it was just in the late 90s where adult film industry was driving technology by applying virtual reality and so on. And you know that China is already forbidding the Bitcoin technology, simply because they realize that they cannot control it. So I know it's within lawyers, what we think this should be regulated, this should be under control. And I think that the entire thing with Bitcoin and also blockchain technology is designed not to be controlled.
Can't be controlled.
So and I know for a fact that the government, they're not going to satisfied by not controlling it. I know already in Sweden that the government bank is looking to create a virtual currency. It's called GLAAM. And also the 5 bigger banks in Sweden who has a monopoly situation, they are driving this fintech based on blockchain. So I think that, coming back to Bitcoin, I think it should not be maybe controlled. Once you control it, it's going to lose its whole purpose of it.
You can't control it for certain. And so that's also something I think that most governments realize pretty early on. Oh boy, this is way bigger than us. What governments can do is control their citizens, okay, and how their citizens report their taxes and what is sold and communicated to the citizenship, okay? So if you think about a security, even Bitcoin, something of this nature, the strongest actions we've seen in the United States are from the SEC, less from FinCEN. FinCEN is not has not a strong enforcement agency. The SEC is built to enforce, and they do so swiftly and they do so very aggressively. So what the SEC has done is they have enforced laws not around the technology nor the coin, right? There's no illegal security. It's the way it's offered. So the legislation is around the offering. It's around the communication of it, and it's around the really around the consumer not being harmed. That's been the tack so far for regulation, is ensuring that there's no harm to the consumer. What we haven't seen yet, and I think it's because nobody can really get their head around it, is how will this really be harnessed and possibly controlled. I don't think you can in Bitcoin. I don't think you can in certain digital currencies, but you just can control, in a way, the non-harming, right, whether that's hackability, the way things are held, making sure that the consumer itself isn't being damaged in the way these are being communicated and used.
On the e-krona point, I mean, we already, there are stable coins that already exist, like digital representations of fiat currencies. That's there already. Some of them not so stable. But the idea behind it is to try and eliminate some of the volatility, which is what the average person doesn't really want. The whole purpose of regulation, I mean, I've tried to, my mom every once in a while asks me, what is this crypto, Bitcoin stuff that you do? And I try to explain it to her. She doesn't understand it, right? And that is where the real risk lies. It's that consumer that potentially that legislation has to protect. And you can't control the technology, you can't regulate the technology, but you can, to some extent, regulate the access points to that technology to make sure that we try and reduce the risk to the average consumer.
Have you bought things on the internet, and when you cheat somebody when you're buying things,
I don't cheat anyone.
Don't you think that's going to regulate itself? Maybe if you promise to send me a fraction of a Bitcoin and you don't, nobody's going to do business with that, So maybe it's going to regulate itself and just let it be, I don't know. I have no idea.
So
Thank you, Bob. We have time for about one more question. I saw your hand go up.
I want to first thank you because you looked who knew something about all of that, and you came to the conclusion it was 1/3. I think I'm in the 2/3, but you managed to speak in a way that I had the impression to learn something. But for me, I've never had a token, nor am I invested in Bitcoin. I read a lot about that, and I think it's fascinating. I'm never going to learn the technology, but obviously as a lawyer I'm interested in the regulation, and somehow I would like to be able to become a part of that world, at least from a fraud perspective. So what would you recommend for these 2/3 that have, perhaps seen some schemes, some ideas about it, but they don't trust to invest because the value go up and down, and they still would like to, like when I had a long time to buy an iPhone. When I bought it, I was introduced into another world. I still don't understand it, but at least I have the impression to be in touch. So could you recommend something, what we can do? Shall we buy a few Bitcoins or look for a token?
Yeah.
What is the entry level for
the entry level?
2/3?
I mean, when I made my first investment, it was incredibly difficult, okay? It used to be far more difficult. It's much easier. So it's a great question. And if you're talking about on a personal level, or you have a client who wants to do this, what's the right entree into this? What I would do is a few-fold. There are certain exchanges, we could talk about this offline, or you come to a group like ours who has what's called an OTC trading desk. So we buy and sell positions in these things on behalf of people's clients. To do that, I would focus first really on Bitcoin. And I would do that because it is the Coca-Cola, right? It's the gold standard. We don't give investment advice. We're not an investment shop. So there's a lot of folks who are, and we could certainly point you to those, who run funds, baskets of funds, crypto funds, investments in ICOs. We don't make any of those suggestions. I would dip your toe in the gold standard, play around for a while, get used to how it operates. Most coins actually move in relation to Bitcoin. So when Bitcoin goes up, most coins rise. When Bitcoin goes down, we don't yet really have contra, hedging positions and things of that nature. It's just, it's too early in the process. You also want to be mindful, just like a stock, you don't want to buy a penny stock as your first stock because it doesn't have a very large float. You want to ensure, if you're putting a fair amount of money into a coin that you are not really intimately familiar with, meaning you don't know the management company of it, or these aren't your, this isn't something you do a lot, that it has a very broad float. These can be highly manipulated. And even Bitcoin, I believe, is highly manipulated at times. So you'll want to look for coins that have a really broad float.
As an advisor as well, what I'd add to that is, it's also new that I don't think any advisor can say that they are an expert in the field. So I wouldn't hesitate about getting involved. I mean, if a client comes to speak to you about it, I wouldn't sort of panic at the thought that you don't understand what the tech is. A lot of the regulatory and legal aspects surrounding the tech are very, very similar to the legal aspects that surround the financial services industry generally. So if you have a good understanding of that, you can apply a lot of the thought process to this new tech.
Okay, we're out of time. I would like to thank our entire panel and for your preparation, and thank you for your attention. We have coffee for you, more coffee for you right after this for a few minutes, and then we'll reconvene for our next panel. Thank you again.